is a control account of the assets. It's a control account. That really means the value of your assets decrease. Got it? Because before you rent out this equipment, maybe the assets is $10,000. But when you come back, due to the damage, the value decreased by $200. So this account still under the assets, but this 200 offset the value of the equipment before you rent it out. So I don't want to get too much complicated, but however, I just give you the concept. The concept could be narrowed down to be very simple. You have 200 cash payout, but you have liability 400 closed. You need to find out any account to enter into 200 on the credit side. And for the small business, you can treat this as revenue. This is fine, nobody cares. However, for the big company, you don't want to, because revenue subject to tax. And you know this is not tax. This is just recovery, right? This is just recovery from the damages. So better way, according to college, suggest probably not enter into the revenue, instead of enter into as the offset part of your assets value. That means your assets value decreased by 200. So this control account still under the assets, but it's not on here because it's the value decrease. It's very similar to depreciation. Very similar to depreciation, but we say this is a damage. Because depreciation usually means just due to the age. Doesn't matter physically damage or not, but this is the actual damage. It's called contra account. Okay. Next one, opposite. Okay, for this period, your company pay out total $7,000 to cover utility, repair. So this is expense. I think this is simple. You pay out $7,000, so your cash decrease and your expenses increase by so much. So I don't care. Next one, your business order and receive 29,000 supplies, but only pay 9,000 cash. So this is another opposite example, right? So let's do a little bit of exercise. When your company receive 29,000 supplies, step number one, we have supplies tier account. But number two, which category supplies belong to? Everybody. Supplies belong to similar to inventory. By the way, when I say similar to inventory, I really mean it's under the assets. Okay, but what's the difference between supplies and inventory? If you are preparing your balance sheet, what kind of item you will put under the supplies instead of inventory? Sometimes it's not important, but I just want to give you an idea what's the difference between supplies and inventory. Remember we talked about this last time, right? If you purchase a whole box of copy machine, the printing paper, you will put under the supplies, like a toner, inkjet, that kind of thing. Okay, the reason why I want to differentiate, supplies is something between inventory and from equipment. If you purchase printer is not supplies. Printer is more like equipment, right? So we have three items very similar. They are all under the assets, but they could be different. So inventory, equipment, supplies, very similar because they are all under the assets category. So it's very easily to differentiate supplies from equipment because equipment is subject to differentiation and supplies is usually does not subject to depreciation. But right now we want to discuss what's the major difference when you're sitting there, you want to put this item either under supply or inventory. What could be the standard? Either way should be fine, but which category you want to put it? Let me put it. This is my suggestion, okay? Not necessary, absolutely, okay? Any item will become your merchandise. That means you're gonna resell. Okay, that means you're gonna resell to somebody else. That is inventory. Even though coming as a materials, but after you put them together, after manufacturing, after the production, you will become part of your merchandise. Definitely, that is inventory. All right, and you know, supplies is something you gotta consume. You gotta consume like a printing paper. You know, you will not resell printing paper. So this kind of items you put as supplies. And the supplies, number one, does not subject to depreciation. And number two, you don't resell it. And number three, usually you will consume it within the period. Within the period, but not necessarily. Sometimes you keep one box paper you use a long time. But you can deduct it. You can deduct it almost. If a small business, you can almost deduct it. If for the business like in the book, you don't report your supplies as expense right away. You keep it as assets, and depends on how much actually you use, you report it as expenses. So by the time you receive 29, you have a supplies increase by 29. You pay out 9,000 cash, so you decrease 9,000, and the 20,000 unpaid, that's your account payable. Okay, so this transaction should be also very easy. If you have book 119, this is very interesting. Your company just prepaid $9,000 cash to cover insurance, renting space, advertising. Remember, I use prepay. Prepay. That means your company paid 9,000 right now. However, those services have not incurred yet, have not happened yet. So easy part is 9,000. Okay, that is the easy part. Remember, you pay 9,000 to cover the future benefit. To cover the future benefit. Let's simplify, okay? Because in the book, you know, it divided to 3 categories. We just say your company prepaid 9,000 to cover total 6 months rent. How about that? Each month the rent is 1,500. And for I don't know, for no reason, your company just prepay 6 months. So on the day your company prepay and no any services really happen yet, at this moment, what should be the other account to match that? We know must be some account to match on the debit side. But step one analysis. What's the name you want to create for this account? Let's say in the book say prepaid. Just say prepaid. Okay? say prepay rent. How about that? All right. But step 2 is always trouble there. So prepay rent belong to which category? As college suggests, even though there are 5, but you can exclude, right? So must be increase on the debit side, and there are only 2, right? If increase is on the left side, from the chart, we know only 2 categories could qualify for this. It's either expense or assets. So we have a 1 of 2 chance to hit it right. Could be assets or expense. Could be which one you want to bet. Remember I said prepay. Okay, let me give you the answer, okay? For the lay person, for those persons who never learn accounting, or for those people who learn accounting but did not learn well, you pick out wrong one. The right answer, the right one is assets. Okay, for those people who never learn, for the lay person, they will pick out expenses because say, oh, these expenses. Oh, by the way, for small business, nobody cares. So for small business, when you pay 9,000 and you use a cash method and you pick out expenses, nobody cares because by the end of the period you got the right results, still the same. But for this book, everything prepaid is assets. Everything prepaid is assets. So I know, you're sitting here, you may have trouble say, why I did pay 9,000, because that's just follow the accounting principle, and especially we are accrual method basis business. Okay, when you pay 9,000, not necessarily become 9,000 expenses. So here you see very interesting transaction, right? Those 2 items, they both under the assets category. They both under the assets. So one asset increase, the other assets decrease. One increase, one decrease. So far so good. How about by the end of the first month? How about by the end of the first month? How should we do? Remember, for each month, the rent is 1,500. Any answer? Or am I clear? I am, right? Okay. I just want to make sure I'm clear. Okay. So any suggest, Peter?
Prepare, reduce, and expense increase.
So can you? Yeah, idea is correct, but by how much? And give me the name of the account. Always remember, I said 3 steps analysis, right? So your concept is on the right track. I know that your concept is fully on the right track, but if you follow my 3 steps analysis, you say 1,500. So which account you want to pick? Which step 1 is always pick out the account, right? So Peter, give you one more chance. No, wait. Which account you want to pick? Which account? Give me the name of the account. How about we pick this account, right? Yeah, we want to pick this account. And this is the assets account, right? When assets account reduce, it's on the credit side. So this is fine. So yeah, I know your concept's on the right track, but I still highly recommend you follow up my 3-step analysis. So you say you want to credit prepaid rent account by 1,500. Okay. How about the other account to match this? So it must be on the debit side. That account must be on the debit side and the same amount. So again, step 1 analysis. What's the name of that account? Expenses. Right now we can say expenses, and you can say rental expenses. So right now we recognize. Right now we recognize expenses. So everybody agree so far? So it becomes easier and easier, right? Easier and easier, right? And by the end, you don't need to memorize anymore, because when expenses account increase, that's on the debit side. It must be. Otherwise, we cannot balance. So any question so far? Any trouble so far? And for the second month, third month, 4 months, 5th month, same thing. You just do the same thing. Just repeat this. And by the end of 6 months, this become 6 times you have 1,500. So by the end of 6 months, this becomes 0. You use all of your prepaid. Alright, no? Okay, so far okay. Am I right? It's not that difficult, right? If we go step by step, again, we go say step analysis. Each step, you just follow up, and you come out the result just so simple, so clean. Alright. Next one. Your company received 3,500 from your customer. Then also you 3,500 that cover your customer pay back $800 account receivable. That means pay something back. Okay, the customer owed to your company before, and the balance is the franchise revenue. So let me repeat it. So today your company received total cash 3,500. Okay, among this 3,500, $800 is your customer pay back the money they owe to you, and the balance is the franchise revenue for this period. They mean earn. Okay, so how can you enter this transaction?
Cash.
So by the time, yes, always pick up. Easy part, okay? When your company receives 3,500 cash, all right. How about 800? Oh, by the way, right now, once you have this fixed here, right? You picked it out already, right? You know, on the credit side, you need to match total 35. So you already fixed 50% already. So you just need to figure out the other part. So right now, we need to pick out another. Right now, we know it's not one account, right? More than one account. So how about $800? Cannot be access, because if access must be 800, that's an increase. Let me see. How can we do it? Oh, I'm sorry, you are right. I'm wrong. You are right. This is reduced, it's not increased. Right, you are right. So the 800 will reduce something. Will reduce something. That's reduce what? When your company receive this 800, one account reduce. What's the name of the account?
Accounts receivable.
Right, account receivable. Account receivable. Okay? Remember, you must pick out something on the right side. On the right side. And assets reduce is on the right side. And that's called account receivable because that's reduced your company's account receivable. And next part is you need to find another credit side for 27, this balance. Revenue, because it's earned, that's revenue. Okay. Good. So this transaction balance. For your midterm exam, you will see very, very similar transaction like this. Okay. You will have only one questions, but there are maybe 6 or 7 small questions just like this. You just do the T account. And again, I don't care about the result, okay? I don't care about I want to see, did you do these 3 steps analysis? Step 1, you pick out the name of the account. Alright, just like this, account receivable. And by that time, I should say you don't have any trouble to identify which category you belong to. Step 1, the name of the account. Step 2, which category. And step 3 is plus or minus. It's increase or decrease. This is it. Then you're done. Of course, you know, by the time when we reach your midterm, the transaction will be more complicated like this. More complicated, alright? So far so good? So far so good? Okay, so let's go back to the slide. Let me see. Okay, so those examples, they are all on your page 118 and 119. If you want to make a mark, okay? Okay, page 118, 119, let's finish there. Another example of this company's income statement, very similar to the one we just went through. So, let's see, okay, here. For this company, under the operating revenue, there are 2 categories. One is restaurant sales. One is franchise. For the operating expenses, the biggest one is cost of goods sold. Alright, for any kind of retail restaurant, no surprise, you will see the biggest one is always cost of goods sold. Then we have a salary, we have administrative, we have supplies. See here, supplies, right? Because supplies is not directly related to your merchandise. It's on the side. Rent, insurance, utility, depreciation here, interest, and other. $21,800 there. Oh, by the way, for each number here, okay, we delete the last 3 digits. So when you see the financial report like this, the 21,800 doesn't really mean 21 million. And for big company like Apple, for each number designated there is the $1 million. So when you see 21,800 on the Apple computer, there's a $21 billion. It's big, okay. So just simplify. Usually, this is one thing I need to talk about that. Did you see the name there? Income before tax, did you see that? income before tax, that really means net profit before income tax. What is the significance there? Why shouldn't we say this is income after tax? Why? How come we always just stop there, say this is income, or we can even say this is a net profit before tax? My questions I post here is, what is the real significance? We want to differentiate net profit before tax and after tax. Let me give you a hint. Why that's important. The hint I give to you is this is corporation. If this is not corporation, there is no too much significance between before and after. But because this enterprise is a corporation, so that is reason why we want to indicate this net profit before or after tax. Anybody know why should we differentiate the net profit before and after? Why? The reason why is, for C corporation, it is double tax. For C corporation, the income is double tax. We need to calculate here net profit before tax to indicate what is the real number this enterprise earn for the whole year. However, this number, it is not subject to dividend because C corporation is liable for corporation income tax. So after corporate pay is income tax, then we receive the net profit after tax. That becomes retained earning. That becomes the number go to retained earning. Alright? So in case I test you in the midterm, you know, because for the midterm I may have other than the calculation, I may ask you why bother to calculate net profit for corporation before tax. As I said, for LLC, no LLC income tax. For partnership, no partnership income tax. For individual, of course, they're all just single layer. For single layer enterprise, you don't bother because no business income tax. Alright, let me see. Returning. That is on your page 124. As I said, by the end of the period, we'll close the book. So we will see the gross revenue minus the expenses. We see the net profit and after pay tax. That number all the way go to equity. So income statement close. For every year, we reset. So income statement is called temporary. All right. So the bottom line will go to equity. Anyone still remember that? When we talk about equity, right? There are two major categories under the equity. Anybody still remember? There are two major categories under the equity. Anybody still remember that? Because we may need to use those two categories for further discussion in the future. Say again? Retained earnings is one, right? What is the other one? I just want to give you the reminding, okay, because we will use it in the future. We have a return earning and what? Contribute capital. Contribute capital. That is the company received the money from the shareholder. Contribute. Okay, this is not earned from the business. That is your investor put the money in. So there are two major categories. On the page 125, this is another example. Consolidate balance sheet here. So I will not spend too much time to repeat it. I give you another one. This is the article, okay, not from the book. So I hope you all receive my email. If not, send me the email, because once in a while I will send you the additional materials to read. This is a very good one, because right now currently the United States will still adopt GAAP. However, in 2 years or 3, we will abandon. We will go to international standard. Okay, so you need to read why, and what's the pro and con between the GAAP and the international standard. And that is one of your homework, okay, due tomorrow. And this is another article, right? And this is your homework. Okay? This is one of the homework. You have 2 homework. Any questions so far? I'm done for the day. Any questions so far? Eventually, today we should talk about more about adjustment, but we did already. Okay, adjustment means there are 4 categories. Okay. One is your company prepay, one is your company unearned, and the other one is opposite. Your client has not paid you, so owe to you, and the other one is your client prepay to you, opposite. We will talk about that next time, so please write it down for the following schedule. So any questions so far? Okay, so still early, okay, so you still can enjoy the beautiful day. Enjoy it. So beautiful. All right, see you next time.